Okay, let's start with the TFSA. A lot of people are not even aware that you can hold other investment like stocks, like bonds, like ETFs in that type of account. So you want to go over what it is.
Yeah, so this is kind of the account that I mentioned for beginners. For the most part, it's probably going to be the best account to start investing in. There is some rare instances where you have a higher level of income. RSPs could be a solid bet. If you were 18 in 2009, you've actually accumulated around $109,000 worth of TFSA room as of the start of 2026. So it does carry over, and it's an account where your contributions, they give you a set amount that you can contribute every single year. Your contributions that you put into the account, you don't get a tax credit for them, but any earnings inside of the account, any capital gains, dividends, anything like that is tax free. And it's also tax free when you withdraw. So the room that you get in the TFSA every single year, it's inflation linked and rounded to the nearest $500. And unlike an RSP, which you'll go over next, when you withdraw from a TFSA, you're not taxed. So you don't get tax deductions, but you also don't pay tax when you pull it out. This is the only investing account that I would say doesn't lose its luster, I guess, as you age. Like regardless if you're 18 or 81, you still get that room every single year.
And probably just the last thing of note to keep in mind, if you do withdraw some money from the account, you can't go beyond the maximum that you have
Yeah.
available. You'll regain that room that you've withdrawn the following year. So you can't withdraw and be at the maximum contribution, say in March, and then think you can recontribute 3 months later. If you're already at your maximum, you'll have to wait the following year.
Yeah, that was the other thing I guess I'll say. You're probably not likely to encounter this if you're just beginning, but a lot of people use the CRA's website to determine their TFSA room. It's not updated very often. Like for people who've over contributed to their TFSAs, like 99% of the time it's because they log in to their My CRA account and it says they have $7,000 worth of room, but what they don't realize, it was updated like 9 months ago and they've
Yeah,
already contributed.
exactly.
So keep
And
track
I
of your TFSA room manually.
But now let's move on to RSP. TFSA, you contribute with after tax dollars. RSP is the opposite. You contribute with pre tax dollars. It's essentially a tax deferral account. So you don't pay tax now. You pay tax when you actually withdraw the money. When the money is within the RSP, it is tax free for the gains. It becomes taxable income when you withdraw the money. Ideally, you contribute when you are at a higher tax bracket and you withdraw when you are in a lower tax bracket. But again, there's no way in predicting that. And that's been one of the things that I've been putting a lot of emphasis in the past is that TFSA gives you a lot more certainty in terms of taxation. Sure, you can make some assumptions down the line, but that is one of the bigger advantages, in my opinion, of the TFSA. You can contribute to an RSP for the first 60 day of the year and apply it to the previous year. You can go to your My CRA account. You'll be able to view your contribution room that you have there. And like a TFSA, you can hold cash investments inside an RSP. There is factors that determine your contribution room for the purpose of this segment. We won't go over them, but essentially it's 18% of your salary. And then you can carry over unused room that you have accumulated over the years. And it is capped at a certain amount. I think it's 33,000. So 18% of your salary up to 33,000, right around there. I don't have the exact amount. And like a TFSA, you can hold cash and investment inside of the RSP. So think of it stocks, bonds, ETFs. You can hold all of that. You just have to make sure, especially for stocks, that they're listed on a major exchange. But for the most part, Toronto Stock Exchange, New York Stock Exchange, even the major exchanges around the world, you should be fine. You can hold a bunch of different type of assets within those types of investments, like Bitcoin ETFs, gold ETFs would also be eligible. You can use RSPs to fund things like a home buyer plan or a lifelong learning plan. I won't go into detail what that is, but if it's something that interests you, you can just Google it. You'll be able to find information. You can withdraw the money at any time, but it is added to your taxable income. And when you withdraw money, the banks or financial institution will actually do a withholding tax, but be careful with that. A withholding tax is just a set amount that they withhold from your payment. It does not mean that it will be sufficient to cover the taxes that you have to pay. So you just have to be careful because there are countless horror stories out there of people thinking they were fine with the withholding tax and in the end they had to pay more taxes.
Yeah, this account is very specific to the individual. It's difficult to say as to whether or not it would be like most beneficial because like pensions can change whether or not it's a good idea
Yeah,
to contribute to
pension
this. Like,
adjustment. Yeah.
yeah, it's very specific, but for like higher income earners, it's actually, it's a very beneficial account because you do get quite a bit of a deferral. Not necessarily in retirement. You could have a down earning year,
Mhm.
particularly, especially like, yeah, you can have a down earning year where you can get the money out. It's a
One
pretty
of the
complex
easiest
account.
examples is someone who goes on maternity leave, woman or even a father that would take an extended parental leave. Even with EI, your income is likely to be quite low for the year, especially if you don't have top up benefits. So that would be an example. But let's move on
Yeah.
to the first home savings account here. A relatively new account, just came out a couple of years ago. Really interesting account. So if you're looking to buy a home in the next 5 to 10 years, listen to this one because that's probably
Yeah.
the account for you.
Yeah, it's a combo between the TFSA and the RRSP. It was created to support those who are saving for their first home because obviously it's very difficult right now to get a home in Canada. The lifetime limit is 40,000 and annual limits are 8,000, and room does carry forward. But the difference here is, so with a TFSA you get the room no matter what. With an FHSA you actually have to open the account. So you will not get the room if you don't have an account open. So if you're going to use this account, open it right away. And where it works like an RSP is contributions are tax deductible. So it will reduce your taxable income, potentially leading to a refund, obviously, depending on a wide variety of circumstances. You can hold investments in the FHSA. The strategy you take is really going to depend, I think, on your timeline in terms of buying a home. Obviously, if you're more short term, you got to really judge whether or not you want to take on a lot of risk because if you buy investments and the market goes down, there's potential you could have less money in here rather than when you go to buy a home rather than what you've contributed. If you don't end up buying a home, you can transfer all FHSA money into your RSP without using RSP room. And pretty much this is the only account in Canada that is tax deductible going in and tax free coming out. If it goes towards a home or if it goes towards RSPs, obviously those would be taxed when you take them out. If you withdraw it, say just as cash, like maybe you bail out on the idea of buying home, it's taxed like an RSP withdrawal. And this account is much more beneficial than the home buyer plan and the RSP. Again, we won't go over that a lot, but with the home buyer plan, you're effectively borrowing your own money and then you have to pay it back. Whereas with the FHSA, it gives you tax-free earnings in terms of investments, things like that, and you can pull it out tax-free, buy a home. There's no repayment obligation. It's a great account. I wish it was around when I was much
Yeah, me
younger
too.
because I would
Yeah.
definitely would have used this. I mean, the best thing to do if you have enough money and it makes sense for your situation would be to use the FHSA and the home buyer plan because
Yeah.
then you can get a lot of money towards a down payment.
But if you only need one of the two, because the home you're looking to buy will not require much more than, let's say, 50,000, and you think you'll get enough returns with just the contribution room from there, then you should just do the FHSA. Like it
Yeah.
is, if you're looking to buy a home and you don't have this account open yet, like pause this podcast
And open it. Yeah.
and go open it, and then you can resume the podcast. But yes, it's a no brainer. Like anyone buying a home that doesn't have this account is making a mistake.